Conversation forward. We've been joined by Jyotivardhan Jaipuria from Valentis Advisors. And Jyotivardhan, good morning. Thank you for joining in. There has been a lot of this stock-specific earnings reactions that we are seeing. We'll get to individual names as well. But starting off with the Bajaj twins, right? Bajaj Finance, Bajaj Finserv, both. The street has become so used to them reporting growth in the high 20s that even a moderate guidance cut has left them disappointed to such an extent. What do you make of this now? Do you use this as an opportunity to accumulate names like Bajaj Finance, or would you wait and see for things to normalize first and then take action?
Yeah, so in general, what I'll say is that a lot of stocks where valuations are high, there the margin of safety is very low, the margin for error is very low. And when you have that sort of valuation, what tends to happen is people are always building in a very optimistic scenario. So anytime where the optimistic scenario is not so optimistic, also it still looks good, but it's not as optimistic as people thought, then market tends to go down. The other is, you've seen a fairly good rally if you've seen the markets in general over the last few weeks. So to that extent, anywhere where you've seen a rally coming, I think in general we'll see some consolidation happening. So a lot of times you may see earnings doing well, but the stock correcting because the stock had run up already in anticipation of good earnings.
Jyoti, hi. Morning. So, what has been your approach to trade? We've seen a lot of the not volatility, but the markets have recovered considerably. They've snapped back up, and trade tensions to some extent have thawed. Even the global markets have recovered. I think it's been up now 5-6 days in a row, and the Nasdaq is back to the levels that it was on April 2nd. So, what's the call on the markets now?
Yeah, Reema. So I guess what we've seen is after that April 2nd, when we had these massive reciprocal tariffs, to some extent, I would think that, the Trump administration is going back, getting a little easier on these tariffs. Because if you see, even probably a fourth of China's imports have got duty free, all the electronics and that sort of stuff. The noise from there is always been more positive in the last few days, saying this China tariffs are not sustainable, a deal will happen. We're going to do a deal with many more countries very soon. So it seems like, they're getting a bit more relaxed on it. They're, they figured that what they did was probably the extreme position and that was like a bargaining tool. But that's not what they can really sustain. They want to get back to more normalized scenario. So I think the market's taking cue from that, saying that, we've seen the worst of tariff play out. And that is the reason markets everywhere is corrected. From where we've corrected and where we've rallied to now, we've probably seen like a 10% sort of rally from the lows. I think we are probably due for a bit of consolidation now, where markets will hang around waiting for the next really positive news to come. Probably in India, the specific concern is this whole border situation and how it plays out. Because our views, it probably will not be a long drawn out battle, but probably some very short strikes which we'll have. But, markets are a little concerned about that. But I think, the general thought is probably it's going to be a very short and swift surgical strike and nothing very major.
Sticking to that tariffs bit, Jyoti, what do you do with these tariff-related sectors now, considering all the uncertainty that's around them? There is still no clarity on how much or whether there will be tariffs on pharma. There is now some clarity emerging that the 25% tariffs on auto imports will stay, and there has been some back and forth here with regards to auto parts as well. What do you do with both autos as well as pharma? For autos, at least, there is also no help from domestic demand either. So what about these two sectors?
Yeah, so, in general, what we had done with autos is, our whole auto exposure was in auto ancillaries, which don't have export component. So this was even before the tariff, because our view was that, the international scenario is not looking great. So we don't want to get too much into companies which are very dependent on the international demand. So the domestic companies are fine. Where we'll see is there'll be some slowdown coming in the whole, OEM space. So, if you're looking at auto ancillaries, which either, got new products which they have just entered into, so that helps ensure demand, even if, the overall OEM demand doesn't grow, or they are diversifying into some newer markets. Those are the things which we have been really focusing on. So we are comfortable with the auto ancillary exposure. But most of these are not geared to US. Pharma is the other sector where we are very overweight. and we have exposure to the US generic pharma. So far, we've not trimmed any of that. In fact, we've been like very steady over there in pharma. Our call is that, even if the tariffs come, and we don't even know whether it's coming because it's been all over the place. Tariffs are coming, not coming. Then he said in 1, 2 months it will come. But just now the move done seem to be like tariffs are coming. Even if it comes, the generic sales to US are quite high. And the way the margin profile is, I don't think Indians can absorb too much of that uh, tariff increase. So ultimately, it will be passed on to the consumer, and that's where I think we'll get some relief coming, because once medicine prices go up in the US, then we'll probably see some rollback of the tariff. Hopefully, but before that comes, because India is already talking to US, and I think all the statements coming from there are India is probably going to be one of the few countries who will do an early trade pact with them. So hopefully, as part of that, Indian generic pharma exports will get a favorable treatment from the US.
Jyoti, you also added your exposure to a chemical company in the quarter gone by, given the sharp fall in the stock price and expected recovery. With the appropriate disclosure, you want to tell us which company is this and what made you like it?
So, without getting into names, essentially for us, it was like a company which is into exports. So, in general, if you look at the chemical market, what happened in the last 18 months was it was getting dragged down because there was a destocking at the dealer level. Demand was weak, plus the destocking was happening, so the demand environment got even weaker. So, our sense is that the dealer inventory levels are very low now. And with that, you probably are starting to see volume growth, which is in line with what the demand growth is. I think over the next 6, 9 months, probably we'll see some dealers restocking happening also, which will boost demand. So that's like, the overall macro scenario for chemicals. Secondly, the stocks have done badly. So they're not very, very cheap at the moment, but they've been one major underperforming sector. So given that there are companies which now on a valuation basis are starting to look good, we are looking at some companies where new capacities have come up, and basically there's a volume growth which is there. The market is able to absorb the volume growth today because the demand environment is picking up. So just the higher utilization of the existing assets will lead to higher ROE, higher margins, and higher profit growth. So that's what we are counting on. Now, this is, since we were talking about tariffs, this is one segment which is vulnerable to US tariffs, because one is like anybody who exports to US has a problem. But even if, let's say, China is exporting to US and they stop exporting, they may start dumping all over the other parts of the world. And so, chemicals is something which we are a little worried about on the tariff environment. And that's the reason we've been nibbling at the sector at the moment, but maybe not taking a very big position on it.
So your big overweights of pharma right now and?
The pharma and financials. So as you know, for the last 6, 9 months, we've been talking a lot of the financials and the banks, and that remains one of our biggest overweights.
What about retail, Jyoti? Because a lot of these companies like Vishal Megamart, D-Mart, numbers for Vishal Megamart at least were on the good side, and you're seeing that in the stock reaction as well today. But as a domestic-oriented sector, what would your analysis be on this retail hyper-local market space?
So, retail as such, we actually don't have exposure in retail as such. And most of it is because we are very, very fussy on valuations. So, our whole CEO's philosophy is we like to buy stuff which is very undervalued. And most of the time we want it as underperforming and, under-owned type of sector. So retail doesn't fit in it because most of the time we grapple with valuations in the segment. And we find the valuation very expensive. So we generally stay away from it. There are some other ways we play consumer, which we find very, very, which much cheaper, at least, or not very cheap, but much cheaper than what the retail space is about.
Okay, just one final quick answer from you, Jyoti. You've done a lot of analysis of the correction seen in small cap indices. And this time also, we've seen the small cap index correct more than 20% from its record high levels. So tell us, what does history tell us about the way forward?
Yeah, Reema, so, history tells us that you should buy the dip. And most of the time, like even today, when we look at it, we are like small cap is looking expensive, probably not make money. But, the index has been there for 21 years. The median correction in the small cap index is 23%. And the median recovery a year later is close to 40%. So essentially, what you have is that, the index goes back to the peak in whatever 12 to 15 months after the correction. And so, somewhere you end up thinking that probably big money can be made if you really bought these dips. You don't know exactly which is the bottom of the cycle. But at some point, if we start to get earnings, environment get a little better, then we'll probably start seeing, small cap starting to do well. A year later, we will look back and think this was like a big buying opportunity.
Indeed. Jyoti, thank you so much for sparing time and joining us this morning with your views on the markets and on specific sectors as well. Take a short break, but before we do that, here's some good news. Network 18 has beaten Times Internet to become the #1 publisher on ComScore. News 18 races past the Times of India to become the #1 news brand in the country. And that's not all. At the social plus on platform leadership network level, Network 18 is the runaway leader as per the social MMX ComScore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor, Times Internet, at 202 million. News 18 has also raced ahead of Times of India in terms of social plus MMX cumulative reach. News18.com overall has clocked 251 million unique views to beat the Times of India overall with 183 million unique views as per the ComScore report for March 2025. Now, as per the ComScore social media matrix report, Network 18 is 2 times bigger than the nearest competitor with a 54% reach within the 389 million overall social population. And speaking about Indian languages, in terms of social plus MMX cumulative reach, News 18 Indian languages is the leader in the category with 182 million unique views as per the ComScore report for March of 2025.